Hello everyone, welcome to Cheongfuli Weekly Report. We bring you the latest price and market analysis of China's steel market every week. Spot prices trended weaker this week. As of press time, the spot price of rebar rose 10 yuan per ton week on week, while the hot rolled coil (HRC) spot price stayed flat. Market trading sentiment weakened week on week, and overall market activity kept shrinking. On the macro front, overseas geopolitical tensions intensified. The US-Iran conflict flared up again this week. The US carried out a new round of retaliatory strikes, striking over 80 targets across Iran with precision-guided weapons as a response to Iran's recent assaults on merchant ships navigating the Strait of Hormuz. Later, areas surrounding Iran's Bushehr nuclear power plant came under US artillery fire. Geopolitical risks lifted international crude oil prices once more, and overseas macro sentiment will stay choppy in the near term. Domestically, the State Council issued the 15th Five-Year Plan Action Plan for peaking carbon emissions on July 10th, laying out comprehensive arrangements for carbon peaking tasks during the 15th Five-Year Plan period. The plan sets clear targets. By 2030, China's carbon dioxide emissions per unit of GDP will drop 17% versus 2025, and non-fossil energy will account for 25% of total energy consumption, which will impose long-term restrictions on the consumption of coking coal and coke. On the supply side, total supply edged lower. The total output of 5 major steel products hit 8.4703 million tons this week, down 171,300 tons week on week. Meanwhile, molten iron production slipped slightly. By product, rebar output fell to 2.0516 million tons, a week-on-week decrease of 113,600 tons. HRC output inched up to 3.0402 million tons, rising 17,400 tons week-on-week. On the demand side, consumption softened moderately. Apparent steel consumption reached 8.3616 million tons this week, falling 59,400 tons week on week. Specifically, apparent rebar consumption stood at 1.9497 million tons, down 150,500 tons week on week, while apparent HRC consumption climbed 91,000 tons to 3.0239 million tons. Demand kept weakening amid the traditional off-season. Market participants hold bearish views on the outlook, and speculative buying remains muted. In terms of inventory, total stocks of the 5 major steel products kept building up, totaling 16.3392 million tons, an increase of 101,900 tons week on week. Breakdown by product, rebar inventory reached 7.0008 million tons, up 101,900 tons week on week. HRC inventory hit 4.4031 million tons, rising 16,300 tons week on week. Overall, China's steel market ran weakly this week. Both supply and demand declined while inventories continued to accumulate, pointing to worsened fundamental conditions week on week. Steel mill margins kept contracting week on week, yet widespread loss-driven production cuts have not materialized, and molten iron output will stay elevated in the short run. The downstream steel market has entered the traditional off-season, leaving little room for growth in construction and end-user purchasing demand. Combined with recent typhoon disruptions across multiple regions, tangible market demand has faded further, mounting structural pressure on steel supply and demand balance. On the cost side, the renewed escalation of US-Iran tensions lifted steel raw material prices, offering interim cost support to domestic spot steel prices. Market sentiment is generally cautious and bearish. Steel prices are set to stay volatile and weak in the short term. The subsequent market trend hinges on shifts in steel supply and demand, as well as the resumption pace of coal mines. Based on the above analysis, operational recommendations, purchase steel strictly on an as-needed basis to mitigate inventory risks. Institutional analysts hold the view that the steel market is currently in the traditional off-season, and weak demand will continue to weigh on steel prices. Nevertheless, daily molten iron output has not seen a sharp decline in the short term. Coupled with the slow resumption of domestic coal mines, raw material costs will continue to provide underlying support. Market participants will focus on policy positives to be rolled out at the key national conference scheduled for late July, which may boost market sentiment. Steel prices are expected to trade sideways in the near term. In summary, steel prices will generally stay range-bound. Close attention should be paid to shifts in steel inventory levels, domestic macro policies, and coking coal supply. Okay, feel free to leave your thoughts, questions, or any related inquiries in the comment box below. And if you found this video valuable, don't forget to follow us for more updates. See you next week.